What's going on, everybody? Jeff here. Welcome back to the channel. Markets closed today. However, I want to prepare everyone for the short week ahead. A lot of Federal Reserve activity, which we'll get into in just a moment. But in this video, I want to talk about an article that was just released from the New York Fed, stating that big institutions and the Federal Reserve's outlook for the rest of this year and next year is starting to change. Their narrative is finally becoming a little bit more in line on how we've seen things over the past few months. I'm going to break everything down for you. And this kind of piggybacks off of the video I made last Thursday, talking about how to prepare over these next 6, 12, 18 months in order to position yourself in a really good spot to ride the massive bull run that normally comes right after a bear market. Now, a lot of you guys have gotten into the stock market after the COVID crash, and you've seen how stocks have reacted in times of quantitative easing, lowering interest rates, and massive stimulus. And eventually, when the economy does get to a point where it cannot turn around on its own, the Federal Reserve will once again revert back to their normal routine, which will eventually be quantitative easing once again. So this is going to give you a little bit of a timeline, and we're going to talk about some very important things. So let's get right into it. First off, this week kicks off on Tuesday with Fed President Barkin speaking, followed by Jerome Powell testifying Wednesday and Thursday. So expect a little bit of volatility and lower volume. But let's get into the article right here. New York Fed model sees high probability of hard landing for the economy. Now, I think this subtitle is kind of ironic. The bank cautions its model outlook isn't an official forecast, but this is like their precursor to, well, hey, we kind of told you so. All right. So we've talked about that soft landing for quite some time. I think that the Fed did actually have a chance, obviously, if they just acted a little bit more aggressively and if energy's price did not just become astronomical. A couple key things in this article. The chances of a hard landing as occurred during the 1990 recession are about 80%. The outlook is more pessimistic than what the model predicted in March. So you see a massive change in tone just from March. Now that actually we've seen what once was to be a peak of inflation, we got that 8.6%, obviously showing that inflation has not peaked. The next thing is talking about the housing market. Now, generally, the stock market is a little bit more forward thinking than the housing market. And we talk a little bit about this. By the time that we start to get out of a recession, the market has already recovered quite some. Okay, it's very forward thinking. But this talk about the Fed's plans to reset the housing market. It's not just about how expensive the housing has become. It's how fast it got there. It took 24 months for U.S. home prices to soar 37%. And in comparison, the biggest two-year spike leading into the '08 housing crash was 29%. Now, there's a lot of things that are different. And this comes from information talking with clients who are lenders all over the country. A lot of things that are different now than what happened in '08. The average credit score of a borrower is about 50 to 60 points higher. Okay. And like I said, they have more equity inside their home. There are a few differences, but it just goes to show on how patterns tend to repeat themselves, at least in partial. So keep an eye on that. Next, you've watched Bitcoin absolutely capitulate over this weekend, starting to recover a little bit. It got as low as that 17,000 mark. When you zoom out and you look at this chart, this is a very, very bloody chart. But you can see this support, which was once resistance, all the way back in 2017. And once again, a little bit before it finally broke out at the end of 2020. We're finding a little bit of a bounce right there. Not really much of a bottom as beginning to form. It's just a little bit of a relief rally, in my opinion. I think Bitcoin does have a little bit more downside, especially because these big funds will need to pull liquidity out of the crypto in order to feed it into the stock market. And if the stock market continues to pull, it's only a balancing act. The last thing I want to talk about before we get into a couple charts, some consumer sentiment, is this right here. I was watching something the other day, and they were talking about that first big one to fall. All right, a lot of times, and this goes back even further than just 2008, but they talk about that first big one to fall. A lot of times, you're going to need a big fund, that one of the big guys, and I already know who's on your mind right now. Don't worry, he's my number one too. But they're going to look for that big institution, that one that was over leveraged, the one that could not be able to change their position quick enough due to liquidity issues that we have clearly seen over the last 6 months, and you take a look at Lehman Brothers, founded in 1847, this one was too big to fail, filing bankruptcy in 2008. It was the fourth largest behind Goldman Sachs, Morgan Stanley, and Merrill Lynch. And don't forget, Merrill Lynch is only around today is because it became a subsidiary of Bank of America. Bank of America actually bailed them out. They were in just as bad of trouble, not as bad, but serious trouble back in '08 as well. So look for one of these big ones to fall. That is a huge indicator that a bottom is starting to form. Don't know if we're necessarily going to get that as of right now. That is a little bit further down the road, okay, over maybe the next 3 to 6 months, but just keep that in the back of your mind. Now, I do want to talk a little bit about consumer sentiment because these really plays a key role, especially when it comes to inflation. Now, consumer sentiment, it basically is a indicator of how consumers feel, their confidence level of their finances, all right? And as you can see, all the way back pretty much since we got out of it in '09, it's been higher than where we stand as of today. Even after COVID, we got that low, about that 70, and all the stimulus that was provided only brought us back up to that 88, which was still a lot lower over the past 5 years, all the way from back from 2015. And here's where we stand at a massive low. Every single time we've gotten to this low, a recession follows, as you can see by all of these shaded areas. So consumer sentiment is very low. Consumer credit is back all the way where it was pre-pandemic, meaning consumers are still spending. You haven't seen that stop, okay, as of just yet. Even in my area, which is only one area, the restaurants are still busy. Adam Aaron even stated that, people are still going to the movies. I saw Top Gun on a weekday. The movie theaters were pretty busy for a weekday, although, however, it is summer, but people are still going out, which means they're probably spending a little bit on their credit, but it's going to come to a point where that limit just gets a little bit higher and higher. Their minimum payment continues to grow, and eventually that spending has to become a lot more discretionary than it currently is. Now, going forward, gas prices, I think, are starting to stabilize a little bit. Okay, the national average today is 4.98. Yesterday was just a hair more, and a week ago a hair more. Obviously, diesel still continues to go a little bit higher. One thing I will point out is an ETF, XLE. This is the energy sector. This is a massive red weekly candle coming off of that high of 93.30, getting all the way down to 73. So hopefully energy prices can continue to subside going into the next CPA. Energy and food are the two leading, indicators and what boosts that inflation in that CPI number to be as high as it is. So keep that in mind going forward, guys. Like I said, I'm going to continue to cover a lot of information on how to position yourselves over the next 6, 12 to 18 months. If you find yourself in a time right now where you're getting chopped up, just be patient. It only takes a little bit of time to be able to get in at the right time in order to ride some of these massive gains. All right, so that's it for this video, guys. I'll see you in the next one.